Hey everybody, welcome to the Social Value Show. Today is the fourth video in our series on ownership and decision making within a corporation, specifically a social value enterprise. And the topic today is about investor ownership. And this one is really more of a question mark. It's interesting because the first two, employee ownership, consumer ownership, were a no-brainer. But when it comes to the risks and the concerns about giving too much say in a business to those who have financial stake, obviously we start getting into some muddy waters, because that has been historically what has resulted in negative outcomes in business. That is the logic, the operating logic of all publicly traded corporations, and it's the reason why all these businesses exist, is to produce profits and to be serving the owners, the financial interests of the corporation or the company. And so, it is definitely with a, treading water, and there's some fine line stuff that we need to navigate in this video. And let me just preface that with, please help me with this one. This one is a tough one because I come from the position of a laborer, and I want to hear from those who do have money to invest and want to invest into a social value enterprise and want to have some say. But I need to understand how we rein in the traditional say of investment. There's other muddy water. For example, if we were to give some say to investors about what they can have some control over, the ones that invested the most would be the ones with the most amount of say, and that is another slippery slope. Whole Foods is the best example in modern time for me that helps us frame the concern. And in Whole Foods' history, they were growing for 20 some odd years as a publicly traded company every single quarter, totally bringing to market the organic side of things in grocery. But then in 2015, their growth flatlined. Other competitors started producing organic products. Everyone started looking at Whole Foods as the most expensive retailer in the marketplace, and that affected a little bit of their brand reputation. But what happened that really got them to be acquired by Amazon was one investor. They call this an activist investor. I forget the name of the actual company. Now, when I say it's one investor, it's one investment group that bought like 12% of their outstanding shares, and because they had more say than everybody else, they literally forced Amazon, or my bad, they literally forced Whole Foods to be acquired by Amazon. And just to give you a framework for that, John Mackey, he is the founder of Whole Foods. He literally wrote the book on conscious capitalism. He's one of the biggest thought leaders when it comes to pioneering a way to do business that takes into account all of the stakeholders. And to see someone who is so value driven have no choice but to sell his company to what many could consider Amazon to be one of the worst companies when it comes to those types of values. They don't have a great reputation for the welfare of their employees or the welfare of other constituents. And the truth of the matter is, because they created a system where investors have say, one investor can come in and can ruin everything. And so, for what it's worth, the company has raised over $3 million from investors. We've been very successful in that sense. And all of those investors, some of which are probably listening to this video, and once again, I welcome your input, but hear what I'm trying to say about the slippery slope of giving too much say to investors. They all were given non-voting shares when they bought into the company. That was important. That was the only criteria I had when we formalized the investment instrument. It was, look, I'll take money from people, but if they want to say in how this business runs, I'll take their advice, I'll listen to them, like I do with all of my shareholders, but I cannot give them the keys to the kingdom, and I can't I can't have them make us do things that are outside of our core values, which I think is going to be the issue with investors. I think we can give investors say over maybe board of director seats, or maybe it's like budgetary discretionary money for business development. There's certain things that I like to give investors say over, but we need to figure out what those reins are. We need to figure out what those chains are, so that investors are given to say they deserve, they put their hard-earned money to work here, but within reason, within the bounds of the value set that we've set out in all the videos here. So with that in mind, we do have an investment opportunity currently on WeFunder. We're talking about royalty structure. So it's not an ownership structure to begin with. It's more of a debt relationship. Still phenomenal return on investment. So investors shouldn't be that taken back. But as we look to how does anyone get say over the company, I think you'll find one common thread. And it's not just because they consumed, it's not just because they labored, and it's not just because they invested, but it's because they did all those things in and above and beyond themselves. They provided more value than they were taking. So if I'm inclined to give an investor say over things in this company, it's not going to be the investor who invested $25,000 and will hopefully see a return of $250,000. I'm already in a position where they're getting far more than they're putting in and whatnot. Now, if that same investor said, you know what, instead of taking the $250,000 in 10 years or 5 years or whatever it is, I'm just going to take the $25,000 I invested and I'm going to cap it at $50,000 because I want you guys to be even more successful and I don't want to harm the business by taking cash out. If that's the logic of that investor, all of a sudden you give that investor decision making, you give them credit, and you create a system that respects all of these same dynamics for employees, for consumers, and for investors. It is when you're not taking what you probably otherwise would deserve, when it's you're giving more than you're taking, that is the recipe for becoming an owner in this type of social value enterprise. It is the way we can make sure that those who are in decision-making capacities are making decisions based on what is in the best interest of the whole. So, we went over employee ownership, consumer ownership, and this video here on investor ownership. In the next video, we will be talking about the actual corporate structure that these things can become an owner on, and we can learn a few things in the same breath. So, in the next video, stay tuned for that, and as always, remember to do good and to share with others. Cheers.